Welcome to lesson 4, guys. In this lesson, we will discuss what kind of trades I take based on the type of box and how you can use that knowledge in your own system and decide which trades are worth it based on what you're seeing on the charts. We will continue with the Roku example because that's the one that we picked up for the first two videos. It has all kinds of boxes and yeah, it was a beautiful trend, so it would be just a nice one to learn from. So let's begin. Let's begin with the base box first. When the price has been consolidating in a huge zone for months on end, we know that the first move out of it will be explosive, right? The only problem is that we don't know when the move actually begins. There are times when the price moves out for a little bit, and then comes right back. This you can see in Square recently. You can probably also see in the Amazon base box that's developing right now, in the Shopify base box that broke out a few months back. The price goes out of these boxes and then within a day or two, sometimes even right away, comes back because it's not ready to trend yet. Most of the times what's happening is the institutions push the price back in the box because they're not done accumulating. So that's a major risk with the base box breakout. And that's why when the price is breaking out of this base box, I don't like to take naked options on it. It's just not worth it. Because the price can come right back or it can chop around a bit before the break really happens. It's just not a quick, fast move which will make it worth it for naked calls and puts and be able to fight the premium burn. More often than not, I have faced losses when I'm taking a naked option out of a base box. So in this case, for example, when the price breaks above 170, above the base box boundaries, what I would probably do is take equities, take direct stocks, and another thing you can do is buy a bull put spread, right? Try and keep your strikes below the first zone because that's our stop. The price can still trend above this first zone. It can come back a bit and then still trend, right? The trend structure is not broken because a higher low can still be created. So if you put on a bull put spread, you will want to keep the strikes below the first zone. So those are the two possible trades I would take on a base box breakout. Now, the next thing I'll try to look for once the breakout has happened is sometimes the price will get out of the base box, and if it rises up really fast, it will move sideways for a bit. It will move sideways and consolidate and wait for the 9MA to catch up. This will lead to a 9MA box. An example is right here, between 270 and 280. You see price moved out of this 50MA box quick, moved sideways for a bit and created a 9MA box. Well, from these 9MA boxes, you should be able to pick up naked options, right? From a 9MA box, pick up naked option for the nearest expiration, maybe at the money or one out the money, and it can be a quick trade. Maybe hold it 1 day maximum, right? Hold it for a few hours, take the quick trade, you will see 100-150% gain, get out. That's the goal of this. You're not there to wait, you're not there for the trend to continue, none of that. It's quick profits. So out of 9MA boxes, such as here, another consolidation right here, you should be looking at short term, very short term, the nearest expiration, long calls or short puts like naked options. That's it. You can also take a small bull put spread if you want. That also works. But again, you have to think about quick exits and the profits are not as much as you can make from the naked option in that case. In this case, I'm discussing all about bull put spreads and naked calls just because the breakout was higher. If the breakout is lower, just do the exact opposite of what we will do when the price is going higher. That's it, right? If the base box breakout, if the price goes higher, you will go long. If it goes below, you will go short. Same for the options. All right, so now that we have discussed the base box and we have discussed the 9 MA box, let's see how I will trade a 50 MA box. The first 50 MA box after the box breakout is a bit different from the second one, right? The first 50 MA box after the box breakout, which is a 9 MA box in the weekly, has a very high chance of continuation, a very high chance. And the move also happens rather quickly. So when you have a 50 MA box right after a big box base box breakout, I like to go big on these. I might put the usual position size for me is around 1 or 2%. In these ones, I might put 5%, maybe 10, depending on what kind of base box it is. If it's a Google or an Apple, yes, I will go big. If it's something like Doku or something else like mid cap, I probably won't go as big. But I still like to swing for the fences when it's 50 MA, first 50 MA box right after the box breakout. And I will put 2 or 3 different types of positions. So if it's a first 50 MA box, yes, I will put some size on the equity, like directly buy in stocks. The second type of position I would take, for example, in this case, above 240, is I would buy long calls. I would long calls, maybe 1 or 2 weeks out, or at the money or one out the money strike rate. You see this quick move out? That's kind of what you can expect before a consolidation for 9 MA to catch up. This quick 2 or 3 day move out is how long I'm planning to hold the option, right? I'm not planning to hold it for the whole expiration period. I'm planning to hold it for 2 or 3 days. It's still more than a 9 MA box where you only want to hold it for a few hours, 1 or 2 hours, maybe a day at max. This one you can hold it slightly longer. So that's the second position I would put on a 50 MA box like that. The third position I would put is a bull put spread. If the box is small enough, I would put it right below the box boundary, lower box boundary. If it's a bigger box, maybe I would put it somewhere in the middle of the box, still below the first zone, but in the middle of the box in order to get a bigger premium. So that depends on the structure of the box, and that is more of a nuanced question. It depends on the situation. But these are the 3 kind of position I would put on the first 50 MA box out of a base box. For a second 50 MA box, there is a higher chance of failure, so I won't go as big. Most likely what I wouldn't do is put more stocks here. Let me think what I can risk. I might put stocks here. I probably wouldn't do naked options here because there's a high chance of failure, right? If there's a high chance of failure, maybe the price comes back, chops a bit more. Maybe the price comes back and just goes down right away. In either of those cases, the highest loss possibility will be from naked options, right? Like the highest amount of premium burn. So we don't want to get involved in that. From a second 50 MA box or like a third 50 MA box, I would probably only put bull put spreads and just more equity. Again, your stops will be the first zone inside the box structure. That's non-negotiable. Where you want to take profits, that depends on you. As I said, the naked options, if I'm going long calls, I will just try to take profits right at the end of the first higher high, like around the first higher high. I'm not waiting for the rest of the trend structure to form, right? I will be patient with the equity and with the spreads because those are still gaining while the price consolidates. But the premium burn on long calls while the price moves sideways or pulls back to the 9 MA is just never worth it. So with that, my exit is probably the first higher high. I don't use this indicator too often, but I have found it's usually very good to figure out the first and the second higher high, right? So you can use it to take profits. It's the Keltner channel with a 2 ATR. A Keltner channel with a 2 ATR, you can use that for estimating where your first higher high will be and taking profits out of long options or short options, like naked options in general. That's how I like to trade all the three different types of boxes. As you can see, most of my trades are happening on the daily. That's my time frame. I might go down to 4 hourly to understand the little nuances. Maybe check out on the weekly to understand what the bigger picture is. But daily is where I'm making my trading decisions. I think that's it. That's how I deal with all these different types of boxes. That's how I trade. If you have any questions, feel free to email me or write in discuss in Hustlers University or in the War Room. And maybe in the future I will make more videos just based on the questions I will get. But that's how I trade this. That's all there is to it. I will see you guys in the next lesson. All right. Hello guys. Welcome to lesson 5 of the box system. Today we will discuss the importance of the overall market environment in making our trading decisions. So, what do I mean by the overall market environment? The overall market environment is determined by the main indexes, right? You have S&P 500, which is the collection of the 500 biggest stocks in the USA. And you have the QQQ, which is the NASDAQ, right? The NASDAQ and the S&P 500 are what determine the market direction. That's what you can use to understand what the macro environment, what the overall environment of the market right now is. That will help you make decisions on individual stocks, because think of the overall market as a river. If you think of it as a river, it's a lot easier to swim with the flow than against it. So if your individual stock is trying to go in the same direction as the overall market, it will be a lot easier for it than compared to trying to go against the market. Imagine if S&P 500 is dropping, it would be a lot harder for your stock to go higher compared to when S&P 500 would be strong and going higher as well. So that's why it's important to understand the overall market environment when you're trading, because that is essential to your decision-making process. Now, if you have seen the free zone-to-zone trading video, you will have an idea of most of what I'm talking about. If you haven't seen it yet, go check it out. It's available for free on HU 2.0. And if you're not in HU 2.0, well, I will send you a link, send me an email, send me a DM. But if you're not in, I don't know why you're not in there. It's great. Come join. All right, so let's start discussing this from a bigger time frame, from the weekly time frame. You already know what zones are. We discussed that in the first video. The zones are important price levels above which the path of least resistance is higher, below which the path of least resistance is lower. So let's mark a weekly zone that's of immediate consequences. It's around 423. You see, acted as a resistance for a bunch of weeks. As long as the price was below it, path of least resistance was lower. Once price crossed above it, it acted as a support on a retest and the price went higher. So if the price comes back here, it is likely to provide some sort of support for the price. And if the price stays above it, well, the path of least resistance will continue to stay higher, which means don't start taking any big short positions, any long-term short positions. The reason I've marked this zone will come into play later in this video. You will understand. So when I'm trading week to week on a daily chart, the most important thing to consider is a daily zone where SPY is, right? The current important zone right now is around the 451.5 level. Price has stayed above this zone for about 6 days. It has bounced off of it a few times. Once this zone breaks, the path of least resistance will be lower to the next zone, which will be around 446. Maybe, yeah, let's say around 446. So what I have seen in my trading is as long as SPY is above its highest zone, the likelihood of a breakout working out for us is higher. When SPY is below it, that likelihood drops. How much does it drop? When SPY is above its latest zone, 8 out of 10 breakouts will work. When SPY is below it, maybe 5 will work. That is a strong hit to the expectancy of our system. So you have to pay attention to this thing. If you cannot define zones easily, or if you're not interested in that, quick hack is the 9 MA, right? If the price SPY falls below 9 MA, I stop taking any new breakouts. That's it. Any of the trades that I already have, if they're acting right, I will keep them. If they're not acting right, I will start cutting them. It just means I'm going in the defensive mode. I'm not saying I'm going short. I'm not saying I'm bearish on the market. I'm just saying the market is supposed to have some chop because the short-term momentum is dying down, and I'm going on the defensive mode. That's it. So once price falls below 9 MA, I get less aggressive. Usually corresponds with the first zone as well, so you can use the 9 MA as a proxy for it. What after that, right? After that, more often than not, the 50 MA comes to the rescue. The 50 MA comes to the rescue. As you have seen since October, the rally, 50 MA has saved it about 8 times. So the positions that were working fine, even though SPY fell below the 9 MA, that I am still holding, if SPY stays above 50 MA, I will keep those positions, right? I will, unless they break the trend structure. As long as they're acting right, I will keep them. Once they stop acting right, once SPY falls below 50 MA, I will move to all cash. Now it's time to sit back and relax and understand what the market is about to do. What is the next step? The next step is to look at the weekly zone, and only when we go below the latest weekly zone will I start shorting. Will I start having medium to long-term like swing shorts. I won't start shorting till the price is figuring itself out above this zone. Only below this zone is when I will get bearish. That's the importance of the first weekly zone. So those are the things I look at. You will understand the market environment is very important in our day-to-day trading decisions, because you want to make trading easy, almost second nature to you. In which case, you want to make decisions that come naturally. Take trades in the direction of the market. Don't try to fight the market. It is usually stronger than you. Over the long run, it will hurt you. All right, that's all there is to this video. I will see you in the next lesson. Hello guys, welcome to lesson 6 of the box system. In this lesson, we will talk about how to create watch lists. If you have been in HU 2.0, you know I upload a new watch list every weekend, highlighting the opportunities or the stocks that I'm looking at for the next week. It saves me a lot of headache during the week because my preparation happens mostly during the weekends, and then I use the week simply for execution. It's a lot harder to trade the markets if you're not prepared, if you already do not have a strategy. It's a lot easier when you already have the strategy, you know what you will do when the situation arises, and when the time comes, all you have to do is go ahead and do it. So I will say 80% of the work for trading happens during the weekends. The preparation is crucial. And in this video, I will show you how I prepare for the markets that are about to come in the next week. So for preparing my watch list, I start with a list of sectors that I've recorded on my trading view. It's a sectors list. I will attach it to the course so you guys can all have it. If you like, feel free to add more sectors to this or just search for it on Google for all the sectors that are available. So when I go through the sectors list, what I do is I go sector by sector. Let's say here we start with crack. What is it? Oil refiners. Yes. So I go sector by sectors and look at the strength in it and if there's a consolidation. In this case, for example, you see it's above 50 MA, but it has spent most of the time below it. It is coming out from a box, but does not seem anything too exciting. I will let it be. Let's look at hack. See, beautiful box here. Beautiful box between 63 and 60. I already have drawn the box. That broke out on 24th August, and look at this. Now we're creating the first higher high. So when I see a consolidation like this in a sector or in an ETF, what I will do is the next thing I will do is compare it to the SPY. In TradingView, you can do that by just writing the name of the sector and divide /SPY. All right, so the comparison is above the 50 EMA, which means it has medium-term positive momentum. In this case, if this filter is met, I will go through the components of hack. You can look at the components of hack on Google, or there's a website called etfdb.com. etfdb.com. So this is the database of all ETFs. You can find all components here. Once I have it, I can search for the components of hack in here and be done with. And then I can go stock by stock to see which ones are setting up. It's a bit slow. Let's come back to this in the meantime. We'll go back and check how I look at the holdings. So this is my process, right? Like another one to look at, XLK, is the large cap tech, right? This is where your Google, Microsoft, Apple, all of them are. So this broke out of a beautiful box around this region, around 140, and look at the rally it had. So this rally is not had by itself, right? Like its components, the Apple, Microsoft, Google, all of them rallied with it. And when you can identify this rally about to happen in this consolidation between 140 and 132, you can size up, you can position yourself to participate in that rally through the large cap tech. Another consolidation was recent. This is the recent breakout of Google and Microsoft and Facebook that happened. Yeah, that also happened on 24th August, and you will see if you go to the Facebook chart, Facebook broke to new all-time highs at that moment. Why is this so slow? August 24th, you see, this is the consolidation between 363 and 350. Once it loads, you will see a box I would have drawn there. And after 24th August, Facebook rallied along with XLK. So these are the things that, like, you start out with the sector and then you can look at the basic components. So the things you will look at is the sector in a consolidation. If it's in a consolidation, you look at its strength compared to the SPY, the overall market. And if that's positive strength, you go to the sector, you look at its holdings, and then you go stock by stock in its holdings to look for boxes. Jesus, I don't know why Hack is being so slow. It usually is not. Let's just look at Hack ETF holdings directly. All right, you say Hack top 10 holdings and we'll talk about it. Cisco Systems, Cloudflare, Fortinet. You go on etfdb.com, you should be able to look at that, the composition. If you want to look at Fortinet, FTNT, you will see it has had a crazy trend this year. Absolutely beautiful. Look at this. Broke out of a box around, what, 212? Just never looked back. Never stopped. All the way to 310. So the 3 steps, again, go through all the sectors, see which ones are consolidating in a box. Second step, check the strength compared to the overall market, which is the SPY. Then go to the holdings, the top 10, top 20 holdings of that sector, and check out which ones have boxes. Now, what I do after that is I have multiple lists. I have A list, B list, and C list. What does that mean? The boxes that are about to break right away and have high options volume, I put them in the A list. The boxes that do not have high options volume, I will put them in the B list. And then the C list is for the boxes that will take some time to develop. They're not about to break out right away. So that's how I divide my watch list every weekend. It's a grind. It's not easy. All of these different sectors, you go through them one by one. And at the start, when you start doing this yourself, it might take 5-6 hours. Over time, you will be able to finish in 2-3 hours. But that's all there is to it. If you have any more questions, ask them. Send me DMs, send me emails, whatever you like. I will send this watch list along with the course, and that's it. That's all there is to box system. Based on if you guys send me more questions, I will create more videos focusing on those questions. And guys, get started. Good luck trading.